Anytime you start to invest, it comes with its advantages and disadvantages. Some advantages are the fact that you can set yourself up to make money passively, you have multiple streams of income coming in, and you are setting yourself up for a wealthy future. Disadvantages in starting to invest can be the time it takes to learn something totally foreign to you, the risks of your investment completely flopping on you, and the unknown factor of if the value of your investment will go up or down. Well, here's my question for you. Is it really a mystery knowing beforehand whether or not your investment will increase or decrease? That's what we're going to go over today. How's everybody doing today? I'm Marketable Investors, back again with another financial video. We're going to talk about the market going up and going down, and whether or not we can figure out if it is going to do it beforehand or it's a complete mystery. I hope you enjoyed the video. First and foremost, full disclosure, I'm not God, funny enough, or a financial advisor. Nobody can truly predict the way the market will go down to the exact date and time 100% of the time. We can get close sometimes though. And the simple answer to this question is just to become a congressman or woman and get insider trading knowledge. That way, you'll know firsthand how a new law or legislation will positively or negatively affect a stock. Okay, I'm joking. Don't do that. It's against the law and it's all alleged. Concerning the stock market though, when I first started, I thought that the price only went up or down depending on the volume. To clarify, how much buy volume or sell volume a stock could have on a particular day. Not to say that volume doesn't have an impact on the share price, but when I followed that alone and didn't account for anything else, I lost a lot of money. So let's go over a few hints and tricks you can use to help predict whether a stock will have an upward trajectory or a downward one. Probably the best way to find a future price for a stock is looking over the fundamentals of a company that has a stock. This usually requires you to look over the financial statement of the company. If you briefly want to see how I do this, check this video out. But essentially, you're checking how much debt a company has taken on, seeing if their revenue and profit are increasing year over year, and many other things. Let's take a look at a past example. Let's say you want to look at buying into a stock like Google. I know, I use it a lot for my examples in my videos, but that's just because it checks a lot of boxes for a lot of the topics that I discuss. Starting around the beginning of February 2025, Google's stock price had around a 20% drop. And if you are investing around that time, you may remember the reasons why it fell so much. Massive plans to spend more on capital expenditures to invest into AI than previously expected, fears of tariffs disrupting trade globally, and antitrust lawsuits from the DOJ. Just to drive the point home a bit further, the stock price was as high as $207 in February and as low as $140 in April. So just imagine you're new to investing and you were told by your friends that if you just buy and hold on to Google, you become rich. I don't know about you, but being down 22% in just 3 months doesn't sound very rich to me. What it sounds like instead is an opportunity to research and see if that stock will remain down or will it make a comeback and grow even larger than before. If you look over the simple fundamentals of the company, as I've stated earlier, revenue, debt, cash flow, PE ratio, which is something that we'll discuss another time, then you would know confidently that the price will rebound. You know this because the company you're researching has solid fundamentals. Now here's the part of investing that I call the buying opportunity. If you bought into Google in 2025 and held onto it, better yet, you bought in at the very lowest point, you would have achieved a 100+% return. Sounds pretty good to me. So here's the point. Never strictly buy or sell based off of what your friends and family tell you. Don't buy or sell just because the price is soaring or tanking. And don't buy or sell just because you hear a bunch of bad press on said stock. It's all about doing your own due diligence. Plain and simple is what I would like to say, but unfortunately, news and legislation does have an impact on stock prices for the better and worse. So let's do the news first. Fundamental analysis is a tried and true strategy to find future prices for stocks. But regardless of if a stock has good or bad fundamentals, sometimes bad press can positively or negatively affect the stock price. As I stated earlier with Google, the new tariff policies enacted by the Trump administration in 2025 affected all tech stocks negatively, but they've all for the most part made a strong bounce back since then. But what's an example of a stock that received bad press and the price never recovered to where it was previously? British Petroleum. BP is an integrated oil and gas company that provides carbon products and services. We've all seen our gas stations for years, probably used them, and you maybe even invest into this stock currently. Hey, Even if you look at the price over the last 5 years, it's up 61%. So why am I using this as an example? Well, if we go back to the year 2000, you'll see a slightly different story. Down around 30% in this time frame, we can pinpoint two key moments that caused the drops. First is the global financial crisis of 2008 that affected the entire stock market. And because this is an oil stock, BP was just that much more affected. That event caused a 40-something% drop. But the really bad press for them happened in April 2010. An oil spill of historical proportions called the Deepwater Horizon oil spill. Not to get too into the details of the accident, but there was an explosion on the oil platform, which is considered the largest oil spill in the history of the industry. Heck, it had to be pretty bad if they made an entire Hollywood film about it. The results of which led to BP being criminally charged by the federal government. Fines and charges costing over $65 billion with a B. I'm sure you can see why this created downward pressure on the stock price. The end result of this was a 50% drop within 2 months of the incident. And an event that happened almost 20 years ago is still recovering its stock price to where it was previously. BP was just like every other oil company, but because of a very bad situation that resulted in them losing a lot of money on top of bad publicity, fundamentals couldn't save them. For the first example that we just talked about, there were some people that saw the housing crash happening before it actually took place in the stock market. They analyzed housing data and saw that there was no reality in which the stock market wouldn't crash. That's how they got ahead of it and made money. The second example, however, is an example of news nobody saw coming. Unless you personally started the explosion, it was just an unfortunate set of events. So you have to be aware of both possibilities. Now, instead of a stock taking a nosedive for a specific reason, let's view a stock increasing greatly for a new reason. New laws or legislation that gets signed into existence that directly affects stocks. I use a more recent example for this section. The One Big Beautiful Bill. This law that was signed in 2025 has had an immediate effect on a handful of stocks just from the bill being signed. Actually, the market was starting another massive rally prior to the bill being signed because it was already anticipating it happening. When laws are publicly announced and have a set date that they are going to be brought before Congress to be voted on, depending on the result, the market will react positively or negatively long before it reaches the desk of the president. And honestly, that's the key to this section. As boring as politics can be, knowing when or how certain laws can affect your stocks can definitely come in handy. And actually, the resulting laws typically results in news covering it. Then it ties back to the previous section we just talked about. View it as a benefit of getting a jump on the news before it becomes news. Some examples of companies that benefited from this bill are Lockheed Martin, General Dynamics, Intel, and Caterpillar. So what does this mean for you? For me, I do a quick search online to check and see if any laws that are being brought forward are going to affect sectors of the economy I'm already invested into. If it'll have a positive effect, I try to buy some before the price really takes off. And if it's negative news attached to the legislation, I try to take as much profit as I can. As we come to a close, I feel like this has to be stated again. Unless you have insider trading knowledge beforehand, nobody knows exactly how the stock market will go all the time. We have some tools we can use to kind of forecast the trend the price will go, but sometimes something as simple as a CEO getting caught saying something negative can send the price downward. The fact that a stock can have excellent fundamentals and still plummet in price because of bad press definitely can be discouraging. But we can't control these things, so focus on what you can control and try to catch the next big play. And this statement goes into how to check or how to find stocks. If you're interested in that, feel free to check this video out or any of my other videos. Like I always say, I appreciate you taking the time out to listen to me ramble about money and investments. This is Chris, the Unremarkable Investor. Have a good one.